Let's get something straight. The biggest threat to the US economy right now is not AI. It's not China. It's not politics. It's something so boring most people scroll right past it. But here's the problem. This boring thing quietly controls mortgage rates, stock market stability, and the real cost of every dollar you borrow. And if you've been asking yourself why mortgage rates are still high, why the market panics out of nowhere, why the Fed keeps talking about rate cuts but nothing in your life actually feels easier, you've been looking in the wrong place. Because this story doesn't start in Washington, it starts in Japan. Japan doesn't usually make headlines. No drama, no hype. But for decades, Japan has been one of the most powerful players in global finance. Not loud, just consistent. For over 30 years, while everyone else was arguing about inflation and tech stocks and what the Fed was going to do next, Japan was quietly supplying the fuel that kept global markets running. And now that fuel is drying up. To understand why that matters, and why it matters to you personally, you have to go back to the early 1990s. Because that's where this whole thing started. Japan in the late 1980s was on fire. Their economy was booming, their stock market was soaring, and Tokyo real estate was so expensive at its peak that the land under the Imperial Palace was worth more than the entire state of California. That's not an exaggeration. Then it all came apart. Real estate collapsed. The stock market crashed. The Nikkei index lost more than 60% of its value, and it took decades, literally decades, to recover. What followed was not a quick recession. It wasn't a rough couple of years followed by a comeback. What followed was brutal, grinding stagnation. No real growth. No meaningful inflation. No wage increases. An entire generation of Japanese workers entered the workforce and went their whole careers without ever seeing a real raise. An entire economy stuck in neutral for 30 years. That's what people call Japan's lost decades. And what Japan did to try to fix it, that's what changed everything for the rest of us. When an economy collapses, central banks cut interest rates to stimulate borrowing and spending. Japan cut rates, then cut them again, then pushed them all the way to zero. And when zero wasn't enough, when the economy still refused to move, Japan went somewhere no major economy had gone before. They pushed rates below zero, in negative interest rates, meaning banks were essentially charged just for holding money. And when even that didn't restart the economy, Japan introduced something called yield curve control. Sounds technical. It isn't. It means this. We're going to keep long-term interest rates pinned near zero, no matter what the market says, no matter what inflation does, no matter what. They didn't just nudge rates low, they locked them there, for years. And that decision sent shockwaves through the global financial system that most people never even noticed. Here's why. Imagine you're running a Japanese pension fund. You're responsible for the retirement savings of millions of people. You're sitting on hundreds of billions of dollars. And every safe investment available to you, government bonds, savings instruments, the stable bedrock of any conservative portfolio, pays you basically nothing. Zero. In some cases, less than zero. What do? You have two choices. You accept the zero and watch the value of everything you manage slowly erode. Or you go find yield somewhere else. No serious fund manager accepts zero. So they went looking. And they didn't look domestically because domestically there was nothing to find. They went global. Massively global. Japanese pension funds, insurance companies, banks, and institutional investors started pouring money into US Treasury bonds, US mortgage-backed securities, European debt, emerging market assets, stocks, real estate. Anywhere in the world that offered a return above what Japan provided, which was nearly anywhere, Japanese money showed up. Japan became one of the largest foreign investors on the planet. Not because of some grand strategic vision, because they had no other option. And that capital outflow created something enormous, something that quietly became the hidden engine of global market stability. It's called the yen carry trade. Here's exactly how it works. You borrow money in Japan at near zero interest, say 0.5%. You convert those yen into US dollars. You take those dollars and invest them in something yielding 4, 5, 6%. US Treasuries, corporate bonds, real estate, stocks. You pocket the difference between what you borrowed at and what you earned. That spread, that gap, is pure profit, as long as the yen doesn't move against you. Simple, devastatingly effective. And when the trade is that clean, you investors don't just dip their toes in, they dive. Hedge funds started doing it. Banks started doing it. Individual investors figured it out and started doing it. At its peak, the yen carry trade reached an estimated $4 trillion. $4 trillion of borrowed Japanese money flowing into global markets, chasing yield everywhere it could find it. That money flooded into tech stocks, driving valuations higher. It flowed into real estate, keeping prices elevated. It found its way into crypto, into private equity, into venture capital, anywhere with a higher return than near zero Japan. And for years, this meant global markets had an almost constant supply of liquidity. Stocks felt stable because money kept flowing in. Credit felt available because there was always a buyer. Risk felt manageable because the floor was always well-funded. But the entire system rested on one assumption. Just one. That Japan would keep rates low forever. That was the foundation everything was built on. Because the moment Japan changed course, the math that made this trade so profitable would stop working. And if the math stopped working, the trade would unwind. And if $4 trillion started unwinding at once, the consequences for global markets would be severe. In 2024, Japan changed course. For the first time in years, the Bank of Japan raised interest rates. Small move. Quiet announcement. The kind of thing that doesn't make the front page. But markets understood exactly what it meant. In a single week in August 2024, global stock markets dropped sharply. The Japanese yen surged in value. Volatility spiked to levels not seen since the early days of COVID. Hundreds of billions of dollars of positions were liquidated in days. Investors who had borrowed cheap yen to fund trades in other assets were suddenly facing a double problem. The yen was more expensive to pay back, and the assets they'd bought were falling in value. Margin calls went out. Forced selling began. And it happened so fast that most people watching their portfolios didn't even understand what they were looking at. They thought it was earnings, or the Fed, or some political headline. It wasn't. It was Japan. It was the carry trade beginning to unwind. And here's the part that should concern you. That was just the beginning. Because Japan didn't stop raising rates. They've continued. Which means the unwinding hasn't finished. It's ongoing. Thus, and the longer it continues, the more capital flows back toward Japan, away from U.S. markets, away from U.S. debt. That brings us to the piece of this that hits closest to home for most Americans. The Treasury market. Japan has been one of the largest foreign holders of U.S. government debt for decades. We're talking about over $1 trillion in U.S. Treasury bonds sitting on Japanese balance sheets. And this matters for a reason most people have never considered. Everyone talks about the Federal Reserve controlling interest rates. But the Fed controls short-term rates, the overnight lending rate between banks. Long-term interest rates, the ones that actually determine your mortgage rate, your auto loan, the cost of corporate borrowing, those are set by the market, by supply and demand. When there's strong demand for U.S. on Treasury bonds, prices go up, yields go down, and borrowing gets cheaper across the entire economy. When demand weakens, prices fall, yields rise, and borrowing gets more expensive, regardless of what the Fed does. Japan stepping back from the Treasury market is a demand problem. And you can't fix a demand problem with a rate cut. This is why mortgage rates have stayed stubbornly high, even as the Fed has signaled cuts. The Fed cuts short-term rates. Mortgage rates follow long-term yields. If Treasury demand is soft, if one of the biggest buyers on earth is buying less, yields stay elevated, and your mortgage rate stays elevated with them. That's not a theory. That's what the data shows right now. And this isn't just a housing problem. Everything in the economy is priced off the Treasury yield curve. The corporate bonds are priced as a spread over Treasuries, which means when Treasury yields rise, corporate borrowing costs rise too. When corporate borrowing costs rise, companies take on less debt. When companies take on less debt, they invest less, hire less, and expand less. The dominoes fall slowly, but they fall. And stock markets feel this too, in a way that confuses a lot of investors. You'll see a company report strong earnings, revenue up, profits up, guidance solid, and the stock will still drop. People blame analysts or sentiment or algorithms, but the real answer is simpler. Stock valuations are built on future cash flows discounted back to today. The discount rate is tied to interest rates. When rates are high, future earnings are worth less today. Or which means even a healthy company with real earnings growth can see its stock price pressured, not because the business is struggling, but because the math of valuation changes when rates stay elevated. Higher rates don't just slow borrowing, they reprice everything. And there's another layer to this that almost nobody is talking about: the dollar. When the yen carry trade was in full swing, traders were constantly selling yen and buying dollars to fund their positions. That steady demand kept upward pressure on the US dollar. As the trade unwinds, that pressure reverses. Traders buy back yen to close positions, which pushes the yen higher and, depending on the speed of the unwind, can push the dollar lower. A weaker dollar sounds good on the surface. American exports become more competitive. Tourism dollars go further overseas. But a weaker dollar also means imported goods get more expensive, which means inflation gets a new source of pressure just as the Fed is trying to bring it down. It's a bind. Raise rates to defend the dollar and cool inflation, but further stress an already fragile credit market. Or ease up, let the dollar slide, and risk reigniting the inflation problem. There's no clean exit. And the reason there's no clean exit is that the system was built on 30 years of cheap Japanese money. And nobody seriously planned for the day that money would start going home. Now here's the question people always ask at this point. Can't someone else just fill the gap? Can't China pick up the slack? Or sovereign wealth funds? Or domestic buyers? The honest answer is maybe, partially, over time, but not immediately, and not at the scale Japan provided. China has been actively reducing its US Treasury holdings for years, not increasing them. Sovereign wealth funds are buyers, but they're selective and price-sensitive. They're not going to absorb a trillion-dollar demand vacuum out of goodwill. Domestic buyers, US banks, pension funds, insurance companies, can absorb some of it, but they demand yield to do it, which means rates have to stay higher to attract them. Which brings us right back to the same problem. Higher rates for longer. Not because the Fed wants it that way, because the market needs it that way to find a new equilibrium without Japan. And that adjustment, from a world built on cheap Japanese liquidity to a world that has to function without it, doesn't happen quietly or quickly. It happens through exactly what you've been watching: stubborn mortgage rates, an unexplained market volatility, credit that feels tighter than the headlines suggest it should be. That's not dysfunction. That's the system repricing itself. The world is slowly, painfully adjusting to the end of something that ran for 30 years. Nobody is going to announce it. No press conference, no headline, no breaking news alert. It's just going to keep showing up in the data, in yield curves, in capital flows, in the gap between what the Fed says and what borrowers actually experience. This is why watching the noise gets you nowhere. The investors who understand what's actually happening right now are not watching earnings calls or Fed press conferences. They're watching Japanese interest rate decisions. They're watching Treasury auction demand. They're watching yen positioning data. They're watching capital flows, because that's where the real information is. The biggest risks in any market cycle are never the ones that get talked about loudest. They're the structural shifts that move slowly, quietly, underneath everything else until they don't. And this one has been moving for years. It's not approaching. It's already here. The question isn't whether Japan stepping back matters. It does. The question is whether you understand it before the next wave hits or after. Because the next time markets drop sharply and everyone scrambles for an explanation, the explanation is already written. It's in the yen. It's in the flows. It's in the 30-year system that quietly funded the world. And the slow, grinding reality of what happens when it stops. Stop chasing headlines. Start watching what actually moves money. Because the biggest shifts never announce themselves. They just show up one day in your mortgage rate, your portfolio, your borrowing costs. And by then, the move has already been made.